So in this video today, we're going to be talking about index funds, and in particular, we're going to be talking specifically about Vanguard index funds, because let's be honest guys, if we're talking about index funds, 90% of the time, we are talking about a Vanguard product. Now, before we get into the video though, I just want to mention briefly for those who are looking to learn more about investing in the stock market, I have that totally free stock market investing course. It's about 4 hours long, multiple different sections, all about getting started with investing in the stock market. That's going to be the top link in the description below, or it's simply freeinvestmentcourse.com. If the URL is not working, you might have to add the www, but the best way is just to click that top link in the description. I've actually had over 3,000 people enroll in this free course already. I've gotten a lot of great feedback, and it's just kind of my way to give back to you guys and give you a really good free introductory education to investing in the stock market. But that being said, we're going to break this video up into 4 different sections today. That way, if you need to skip ahead, maybe you already know what index funds are, or maybe you're just looking for one specific thing. But the first thing we're going to talk about is what are index funds. The second piece, we're going to talk about why do people buy index funds? Why would you invest in them? Then we're going to move on and talk about Vanguard index funds. We're actually going to jump into my computer and I'm going to do a screen share and we're going to go on the Vanguard website and look at a couple of different funds. And then finally, we're going to talk about how to buy index funds. And I'm going to share with you guys my #1 recommendation as far as where to buy them. And believe it or not, it's actually not buying them from the Vanguard website. So maybe you'll want to stick around to the end, or if you want, check out the whole video, or there's going to be timestamps down in the description if you decide that you want to skip ahead. What we're going to talk about first is what is an index fund. And an index fund is very simply a collection of stocks and bonds that are designed to replicate an underlying index as closely as possible. So by far, the most popular index fund out there is called VOO. It's called the Vanguard 500 Index Fund. And essentially, that index fund replicates the performance of the S&P 500 as closely as possible. And the S&P 500 is simply 500 of the largest publicly traded US companies. So imagine if you took the 500 largest companies out there, like Apple and Google and the 500 largest, and then you invested a little bit of money into each of those different companies, well then you would effectively have the S&P 500 index fund. So that is basically what it is. There are tons of different indexes out there. You have the NASDAQ index, for example, or the Dow Jones Industrial Average, or you have industry or sector specific indexes like the semiconductor industry. So basically, it's a way to capture exposure to the entire broad market or a specific market or a specific industry. So for example, if you wanted to invest solely in the semiconductor industry, but you didn't want to particularly invest in one or a few specific stocks, you could invest in a semiconductor index fund, also known as an ETF. Now, an ETF is simply an exchange-traded fund. So you take this index fund that we already have built here that is basically replicating the performance of an underlying index, and then you just simply take that fund and break it up into pieces known as shares. So index funds, ETFs, we're going to probably use those interchangeably throughout this video. Most people buy index funds through an ETF. That way you can buy and sell them on the open market just like you would individual stocks. And it also lowers the barrier to entry, where the minimum cost to invest in an ETF is just the cost of 1 share. But later on, I'm going to share with you guys my favorite way to buy ETFs, and it's a way that you can buy them without worrying about that share price because of something called fractional shares. And then the other thing you'll also find with index funds is, let's say for example, you're looking for a growth-oriented or income-oriented approach to investing. Well, you can actually find index funds that will satisfy that need for you. So you can find high dividend yield index funds. You could find index funds that would give you exposure to the cannabis industry. So there are so many different niche index funds out there. If you're looking for something, it probably already exists. So it's a way to basically passively invest in a broad market or get maybe global market exposure through some global index funds, or it's a way to basically bet or invest in one particular industry without maybe selecting the key players. So for example, let's say I wanted to invest in the cannabis industry, but I didn't know, okay, is Canopy Growth Corp the best bet? Is Kronos Group the best bet? I don't know. So I could instead place a bet on the entire cannabis industry through an exchange traded fund. So you can either passively invest in a broad market, or you can go ahead and make a bet on a particular industry, or you can also find other growth-oriented, income-oriented, or high-income ETFs out there based on whatever it is that you are looking for. So that being said, why do people buy index funds? Why are more people investing in ETFs? And we're actually seeing a trend here which kind of blew my mind that I want to share with you guys. And the trend that we are seeing here is that there's actually money funneling out of mutual funds. And mutual funds are basically like what people compare an index fund to. And this will make more sense once I explain point number one here. But what we're actually seeing take place is money is actually funneling out of mutual funds, and more money is moving into these index funds and the robo-investing, which is basically, rather than having an active person managing your money, you have an algorithm managing it for significantly less money, or you simply passively invest in ETFs to avoid paying those fees altogether. So the trend is moving away from the traditional financial advisor mutual fund route and more towards this passive approach to investing known as ETFs or robo-investing. And with the robo-investing, they're putting your money in ETFs anyway. They're just allocating it for you, or basically deciding how much of your money goes into each fund. But there's basically 7 reasons why people buy ETFs in the first place. Number one is the biggest one out there. And it's this concept of owning the market versus beating the market, all right? And this is kind of a staggering statistic that a lot of people are not aware of, but the role of a mutual fund is to basically outperform the market, because if you're investing in a mutual fund, the goal is to have a better return than you could get from just buying an index fund. But the scary truth is that most of these actively managed mutual funds are actually not even beating the market. The number that people often throw around is that 90% of actively managed funds don't actually beat the market. So let me just explain that to you, okay? That's basically this. You're paying people to manage your money. You're paying mutual fund managers to sit there and read up on investments and decide what to do with your money. You're paying them a fee, but they're not actually beating the market. So you're essentially paying them to do this job that 90% of them are failing to do so. And so a lot of people have woken up to this, and that is why money is flowing out of mutual funds and into index funds and the robo-investing, which is a passive own the market approach versus trying to beat the market. So we know from statistics, most money managers are unsuccessful at beating the market, and also most individual stock investors, your average Joe investor, odds are they're not going to beat the market either. So just statistically speaking, this is the best approach to investing, which is owning the market through low-fee index funds versus beating the market. And even the greatest investor of our time, Warren Buffett himself, has said that his best advice for investors out there is to dollar cost average. So we're going to get into that in a little bit here. Dollar cost averaging being continuing to contribute over a long period of time. Buffett says you should dollar cost average into a low fee S&P 500 index fund and forget about it. So if the greatest investor and stock picker of our time is telling people to invest in index funds, that should be indication alone that that's what most people should be doing. The second reason is that index funds are going to be a lot cheaper. So when you're paying for people to actively manage your money, it's going to be more expensive. You have rooms full of people analyzing investments and making decisions. And so typically speaking, you're going to see fees for a mutual fund ranging from about 0.5% to 1% per year, some being even more, not to mention front load fees, which are very common. And that essentially means you have to pay a certain percentage of your assets to that fund before they even invest any of your money. So let's say you had a mutual fund with a front load of 2.5%, and you're looking to invest $100 with them. Well, they wouldn't even take your money in the first place, but 2.5% of your money would be going right to them before it's even invested. And then 0.5 to 1% is going to be taken out as a fee every single year, regardless of whether or not they beat the market. So even if they underperform the market, you better bet they're still collecting their fee. So on the other hand, investing in the Vanguard 500 ETF, which is the most popular ETF out there, well, that index fund has a fee of 0.03% when purchased as an ETF, which is how I recommend doing it. So you go from having these mutual funds that often have a massive front load fee, where you pay this fee before you even invest, and then they're collecting 0.5 to 1% every single year thereafter, to simply paying 0.03% fee per year, no front load fees. So significantly cheaper. And the reason is because these index funds are not actively managed. They're simply replicating the performance of an underlying index as closely as possible. So they look at the S&P 500 and they look at what companies are included in that index, and then they build a portfolio replicating that as closely as possible. Most of it is simply just handled electronically with minimal human involvement. The third reason is because it's passive. It's lower risk than individual stock ownership. If you're investing in individual stocks, you could easily see 20, 30, 40, even 50% drops in your stocks. Typically speaking, under normal market conditions, you wouldn't see that kind of volatility with an index fund, assuming it's broad market exposure. If you're in some kind of leveraged ETF or something like that, it's entirely possible. But if we're talking your basic run-of-the-mill ETFs, you're not going to see that level of volatility, which is the up and down movement of the price. So for beginners, it's a very beginner-friendly investment because it's easier to stomach the drops when they happen, and you're not going to see these drastic emotional price swings. Number four, the fourth reason people buy them is following that strategy of dollar cost averaging, which is essentially continuing to buy shares or continuing to add money to the fund month after month, regardless of what that share price is doing or whatever the fund price is. And so the reason behind doing that is that sometimes you're buying shares when prices are high. Sometimes you're buying shares when prices are low, but by regularly accumulating shares on a monthly basis or quarterly, whatever it may be, you're paying the market average for those shares. And so dollar cost averaging into an ETF, that's a very passive strategy that's honestly probably your best bet when it comes to investing, statistically speaking. And when you have experts like Warren Buffett recommending it, that's honestly the best approach for most people to take to investing. Number five, you have diversified exposure. You're not just investing in a handful of stocks or one particular stock. You're investing in baskets of different companies. So if you're investing in, S&P 500, you're diversified across all these different industries. And even if you're investing in a sector-specific ETF like financials, for example, well, you're diversified across all of these different finance companies and banking companies and all of that. So it's diversified exposure rather than having all of your eggs in one basket. Number six, people like to invest in these because of the ability to earn compound interest. Now, you can still earn compound interest through dividend stocks and real estate and other different ways by reinvesting your returns, but it's really easy with index funds because they typically pay dividends on a quarterly basis, and then you just take that dividend, reinvest it back into more shares, and then your dividends earn more dividends, and you're earning that compound interest and over time experiencing that exponential growth. And then number seven, another reason people like index funds is because of something called a TDF, a target date fund, which is an index fund designed for retirement. And if you guys stick around to the end of this video, I'm actually going to show you a TDF in action, which is, if you're a finance nerd, you might think that's pretty interesting, but it's honestly one of the best retirement tools out there. So most people, when it comes to investing in index funds, they simply passively invest in one fund or a couple of different funds, and then they're regularly investing maybe every month or every quarter, and then they're reinvesting those dividends to earn compound interest, and that's about all they're doing. That is their approach to investing, and rather than trying to beat the market, they're just passively owning the market, and they're resting easy knowing that they're going to outperform 90% of the active stock pickers out there, whether it's individuals like myself or big funds out there. That is the best strategy for most people to follow. So now what we're gonna do, we're gonna jump into my computer, go on the Vanguard website, and take a look at a couple of the different index funds, and then we're gonna move on and talk about the best way to buy index funds right now. Okay, so here we are over on the Vanguard website, which is going to show us a list of the different ETFs that Vanguard offers, but there's also a number of really good educational resources on this website as well. I'll just briefly go over a couple of these things here. We already covered a lot of this earlier on in the video, but it's good to just have maybe things said in a slightly different way. So over here on the website, Vanguard goes into detail about what is an ETF. And the ET, again, stands for the exchange traded. That means you can buy it on a major exchange, just like buying and selling an individual stock. And then the fund is a collection of many different individual stocks or bonds within one fund that's going to give you that diversified exposure. A couple more reasons here why people invest in ETFs, if you're not sold on them already. Well, because you're being spread out across many different stocks and bonds, there's less risk there. And so if you don't have high risk tolerance, if you're new to investing, or you just kind of like a passive approach, all of those are good reasons to be investing in index funds. And the other thing to remember as well, as we already talked about, most of the professional stock pickers out there that manage mutual funds, well, they don't even beat the market. So unfortunately, your odds of beating the market are just not good. You probably won't beat the market. I'm not discouraging you from going out and, buying some individual stocks. As you guys know, I'm also an individual stock owner. But just understand that statistically speaking, the best approach to investing is diversified exposure through low-cost index funds. And I think buying through ETFs is the best way to go about it. So in a little bit here, I'm going to show you guys what I believe is the best way to buy Vanguard index funds. It's not through the Vanguard website, and I'll explain why that is. But I recommend buying them through ETFs, through a commission-free broker, and I will have one I'm going to recommend to you. We're going to log into my portfolio on this platform, and I'll show you exactly how you can get started investing in Vanguard ETFs commission-free with this platform. So beyond that, the other reasons for investing in ETFs, less work. Obviously, it's going to be a lot less time-consuming to just invest your money passively into an ETF rather than, actively picking stocks. And it's significantly lower cost because you're not paying for active money management. So there's not teams of people determining what's going to go into these ETFs. It's all passively managed because they're simply replicating an underlying index as closely as possible. So there are not teams of experts, analyzing companies and reading up on them and then deciding what to invest in. You're simply passively investing in indexes through the index fund. And then, of course, we're really focusing on keeping costs as low as possible. And while there are a lot of brokerages out there that are commission-free, and the one I'm going to recommend to you is commission-free, there are still a number of brokerages that still charge trading commissions. And that may not sound like a lot of money, $5 to $10 per trade, but let's say you're following a strategy of dollar cost averaging, and maybe every single month you're putting $500 into the VOO, the Vanguard 500 fund. Well, if you're doing $500 per month, that's going to be one trade per month. And let's say it's even $5 per trade. Well, over the course of a year, that's $60 that could be in your trading account. That's $60 that could be buying you more of a share of, the Vanguard 500 ETF, but instead it's going to your broker. So I do not recommend paying commissions. There's a variety of commission-free options, and I'm going to show you guys my number one pick here in a little bit. But I just want you to have that in your mind of every time you pay trading commissions, that's money that could have gone into your brokerage account that could have stayed invested. And maybe $5 to $10 doesn't sound like a lot, but if you're dollar cost averaging and you have many trades per year, that does start to add up, and that's just money bleeding out of your account that could be invested. Okay, so that being said, we are now on the page here that shows us the different Vanguard ETFs that are available. And I have links for all of this stuff down in the description below if you guys want to open them up and follow along or whatever you decide to do. But I have links down in the description. So As of making this video, Vanguard has 59 different ETFs available, and I know this may look totally overwhelming to you guys. You might be thinking, oh my god, my head is spinning. It's really not that much information here. And I'm going to specifically talk about, I believe, 5 ETFs on this list that are ones that people typically gravitate towards. I mean, you can get very specific here in terms of these ETFs. For example, mortgage-backed securities in terms of bonds. There's all kinds of stuff you can get into here, especially with the stock market as well. Mega cap companies, mega cap growth, mega cap value. So basically what I want to focus on though are the core ETFs that most people talk about when they are investing. And I'm using ETFs and index funds interchangeably here. So if I'm going back and forth, understand I'm meaning the same thing here, okay? So in terms of the ETFs that most people talk about, the number one ETF that people refer to is this one right here, the S&P 500 ETF. It trades under the symbol VOO, and it is the replication as closely as possible of the S&P 500 index, which is the 500 largest publicly traded companies. Now, as far as this ETF goes, it carries an expense ratio of 0.03%, which is extremely low, and the share price is $264.53. Now, that share price right there is one of the issues people often run into with their brokerages, is because unless your brokerage offers you fractional shares, you would have to buy shares in $264.53 increments. So maybe that's not a problem if you're investing $10,000, but let's say you have $500 you're looking to invest. You're only going to be able to buy one share through that broker, and then you're going to have to save up more until you can buy another whole share. Well, the good news is the brokerage I'm going to recommend, not only is it commission free, they also offer fractional shares, so you can invest in a fraction of a share, which allows you to remain fully invested. And that specific number is you can invest in 1/10,000th of a share of any given stock that trades on the New York Stock Exchange or NASDAQ, and obviously this includes ETFs as well. So we got some other useful information here. We can see what the year-to-date return is on this fund, which is 16.99%. The 1-year return being 4%, 5-year return being 10%, and it hasn't been around for 10 years. But we can see since the inception, the average annual return here has been 14%. Now, this has been in a roaring bull market, so over time, we're going to see that number probably move closer to 9 or 10. So just keep that in mind as we're going through here. So if we actually click into this and look at the VOO, the Vanguard 500 ETF, it'll give us some more information about what it is that we're buying. So what it says here for us is this invests in the stocks in the S&P 500 index, representing 500 of the largest U.S. companies. The goal is to closely track the index's return, which is considered a gauge of the overall U.S. stock returns. Offers high potential for investment growth. Share value rises and falls more sharply than funds holding bonds, because again, you're in 100% equities or stocks in this portfolio. So higher risk, but higher potential return. More appropriate for long-term goals where your money growth is essential. So if you're somebody who's 5 years from retirement, you're not going to want to put all of your money into this fund because you are going to need that money in a shorter period of time. So you'd be looking more at fixed income investments and bonds and lower risk but more conservative stuff. So this is more for somebody who's younger, and you can also dial in your allocations based on what you're doing with that money and how long you have to grow your money. So for example, if you're in your 20s, maybe you have 10% of your money in bonds, 90% in stocks. Maybe you're in your 70s and you have 90% in bonds and 10% in stocks. Now those aren't exact figures, but that's just to give you an example of how people will use these assets to create a higher risk or lower risk portfolio for themselves. Again, this tells you the symbol VOO. There's nothing else really you'd want to look at here unless you really want to get into the nitty gritty. And you can also see the performance versus the benchmark, and it does replicate it pretty closely with the S&P 500. One question people often ask is how does it work with dividends with index funds? Well, the dividends are going to be paid on a quarterly basis, just like with most stocks out there. And then obviously, if you're looking to maximize your returns, you're going to want to reinvest those dividends. And the good thing is, the brokerage I'm going to recommend to you guys, M1 Finance, they allow for dividend reinvestment, so you can earn compound interest. Or if you just want to collect those dividends and, do something else with them, you can also do that as well. So now I want to answer the question that I constantly get when I talk about ETFs. And that is, should I buy ETFs through the Vanguard website, or should I buy them through a brokerage as an ETF? So if we click right here, we can see that the Vanguard S&P 500 ETF is also available as an Admiral Shares mutual fund. So let's take a look at these two and talk about what would be the better fit for you. And again, it's going to largely come down to what's easier for you to remember, what platform is more convenient. But there's actually a big difference here that a lot of people aren't aware of. And strangely enough, it's actually more expensive to buy through the Vanguard website. It may not be the case with all of the funds, but with the ones that I've looked at, number one, the minimum investment is significantly higher, and number two, the expense ratio is higher. So here we are looking at the Admiral Shares Mutual Fund. This would be buying this through the Vanguard website, and the expense ratio is 0.04% with a minimum investment of $3,000. Now, if we go back here and look at the ETF, that expense ratio is 0.03%. So it's actually cheaper to buy it outside of the Vanguard website. And as far as the minimum investment, well, if you're in a brokerage that only allows the purchasing of whole shares, your minimum investment is the price of one share. But the brokerage I'm going to show you allows fractional shares, so your minimum investment is a lot lower. In fact, the minimum to open a brokerage with them is $100, and so you could pretty much have a minimum investment here of $100, open an account with them, and then start building a diversified portfolio of ETFs or invest in some of their pre-built portfolios. So this is by far the most popular ETF that people talk about, VOO. I just want to show you guys a couple of other ones here just to, show you some of the different funds that people often invest in. But before I do that, I just want to go over the different categories here so you guys know what's available. Obviously, you have your bonds. You have treasury bonds available to you, which are going to be considered to be the safest investment out there, your treasuries. And then you have investment grade corporate bonds as a category. And then you also have tax exempt bonds, which are going to be municipal bonds. So if you want to have exposure to those different types of bonds, you can do so through these ETFs. Then they have all kinds of US stock ETFs, large cap, mid cap, small cap. Then you can get exposure to international markets. So here's one right here, international total world bond ETF, total international bond ETF, emerging markets bond ETF. So you can get very specific here in terms of what you're looking for. Then they have international stock ETFs that are going to give you exposure to global markets, emerging markets, Asian markets, European markets, whatever you're specifically looking for. And then you also have sector and specialty ETFs. And these can be particularly interesting for people. So one reason why you might buy into one of these ETFs would be if you had a hunch. So let's say, for example, you believed that the financials industry was going to outperform other industries or outperform the market over the next 5 years. Well, maybe you don't want to buy Wells Fargo and, Chase Bank and Bank of America stock because you don't know which one is going to do well. You just think the industry as a whole is going to perform well. Well, one of the options you have available to you is to purchase a sector ETF of the financials market. So this would be this one right here, VFH. You can look at the return and everything. But if we actually open this up, we can take a look at what are the actual largest holdings of this particular ETF. So as we scroll down through this website here, we can see different information about this as far as, what sectors are involved in this fund. The number of stocks, 423, $7.7 billion in assets, and then 42% of the money is in the 10 largest holdings. If you want to know what those companies are, they're listed right here. So it's JP Morgan Chase, Berkshire Hathaway, Bank of America, Wells Fargo, Citigroup, American Express, US Bancorp, CME Group, Chubb, and Goldman Sachs. So if you, again, wanted to be bullish on a particular industry, without picking the winner, you can just bet on the industry as a whole if you believe it's going to outperform. And there's a bunch of different industries here. You can find ones for energy, financials, healthcare, industrials, information technology. And then this is also a popular one people invest in too, which is VNQ, which is the Vanguard REIT, which is Real Estate Investment Trust. The easiest way to explain that is it is real estate that trades like a stock. So the underlying fund owns real estate, and then your dividends is basically the income produced from that property. In order to be classified as a REIT, 90% or more of the profits must be passed back to shareholders in the form of dividend payments. So that's another interesting way to get some exposure to real estate through the ETFs. But that being said, these are available to you here, all these different sector-specific ETFs. I just want to go ahead and show you guys a couple of the other popular ETFs people typically may include in their portfolio. One of them is this right here, VXUS. This is the Total International Stock ETF if you're looking for exposure to stocks outside of the US. And so what this is the total stock market excluding the US. So if you were looking for global exposure, this may be one way that you decide to do that, is through VXUS, Total International Stock ETF. So basically, every company out there except for the ones in the United States. Another popular one is this one right here, BND, the Vanguard Total Bond Market ETF, if you're looking for broad exposure to bonds. I don't personally invest in bonds. This is just because, I'm young. I don't really have the need for it right now. But a lot of people will just include this in their portfolio for a broad exposure to the bond market rather than specifically saying, oh, I want to invest in emerging market bonds or US treasuries. And again, just to show you guys another example of this where, again, buying through ETFs is actually cheaper, here we go right here. Vanguard Total Bond Market ETF, BND, expense ratio of 0.035%. If you were to purchase as Admiral shares through the Vanguard website, again, $3,000 minimum investment and an expense ratio of 0.05%. So in most cases, you're actually saving money by investing through the ETFs outside of the Vanguard website. And then the final fund I want to show you guys here, and there's more you may want to explore on your own, but VTI is another popular one. This is just the entire US stock market. So basically every publicly traded US company out there would be included on VTI. The difference between this and the VOO is that VOO is the 500 largest companies, whereas VTI is capturing exposure to the entire US stock market. So this is just another one that people will oftentimes include in their portfolios. And it really comes down to, what are you looking for? You're looking for more risk, less risk, and you would kind of look at these and see, which one is a better fit for you. But at some points you may see VTI outperform VOO, so it's not like there's any right or wrong here. But I know you guys may be looking at this and your head may be spinning and you're saying, what do I invest in? I got to build a portfolio. Well, now what we're going to do, I'm going to switch over. I'm going to show you M1 Finance, and it takes all the guesswork out of the equation here. If you want to build your own portfolio from scratch, you have the ability to do that, but they also have expert-built portfolios that are built by experts. There are no fees associated with investing in them, and it just takes all the guesswork out of the equation. Okay, so here we are inside of my M1 Finance portfolio. As I'm sure you could have guessed, this isn't my main portfolio. I just put $100 in here. That way I have a really good model to show you guys what M1 Finance looks like. My reason for not investing fully with M1 Finance is to be completely honest with you guys, I just haven't gotten around to transferring my brokerage. They are my number one pick by far, and I'll go into many reasons as to why that is. So just to show you my portfolio here, this is a $100 portfolio I started out with, and as you can see, one of the chunks of my pie here is VOO, the Vanguard S&P 500 ETF. And so this was 50% of my portfolio when I initially built it. And then I invested my money across a couple of different stocks, Amazon, Microsoft, and Apple. So obviously I've gotten pretty stellar returns here, up 31% on my fractional share of Apple, up 32% on my fractional share of Microsoft. Amazon hasn't fared too well, up 4%, 3.5 or so, and then up about 8.2% on my Vanguard 500 ETF. So you can do exactly this. You can build your own portfolio from scratch with whatever, stocks and ETFs that you want, or you can take advantage of the expert pies. And if you guys do decide you want to learn more about M1 Finance, take a look at the platform, check it out. There is a link down in the description below. For the purpose of full transparency, I will tell you it is an affiliate link. And so if you do use that link, I will earn a commission at no additional cost to you. Your use of that link is, of course, not required, but it is very much appreciated as it, allows me to put videos like this together. These are somewhat time consuming. I love talking about this stuff, but your use of my links really does help me out in terms of being able to continue to provide these types of videos online for free. But that being said, now I want to show you guys how you would go about investing in some of these passive portfolios through M1 Finance. So first of all, in terms of doing research on this platform, it's really easy and it's very user-friendly. So up top here on the research tab, you can look at stocks, you can look at specifically funds, you can look at your pies that you've already built. You can have multiple different pies here if you wanted to have like a passive pie and an active one and compare the two. And then you can also look at the expert pies, which are all pre-built portfolios that you can invest in. So we'll start with these because I think this is what most people are going to be interested in. And then if you also want to be active with your selection, you can build your own portfolio from scratch. And another one of the advantages of going through a brokerage like this, not only are you actually in most cases paying a lower expense ratio than investing on the Vanguard website, but you also have the flexibility of investing in other funds like BlackRock, or there's a number of different funds out there. Like let's say you're looking for a semiconductor ETF. You may not find that with Vanguard, but I'm willing to bet there's going to be another provider out there that offers that fund. Well, if you were solely investing through the Vanguard website, you wouldn't be able to buy anything but Vanguard products. Whereas what I'm showing you guys here with M1 Finance, you can buy anything that trades on the major exchanges. So we'll start off here by looking at this one right here, just stocks and bonds. This is as simple as it gets. It's just an allocation of stocks and bonds with two holdings, okay? So let's say, for example, you are younger and you have a high tolerance for risk. Let's say you went with a 90-10, 90% stocks, 10% bonds. If you click on it, it'll show you the performance and it'll show you the underlying holdings here, which is VT, Vanguard Total World Stock Index Fund, and BND. We already talked about BND in terms of bond exposure. So it's the total bond market and the total world stock market, 90% stocks, 10% bonds. It would be as simple as picking this portfolio and then continuing to contribute to it on a regular basis through dollar cost averaging. And then, as I'm sure you guys can guess, on the other end of the spectrum, the 1090 is simply 10% in the World Stock Index Fund and 90% in BND. So if you just want to keep it simple and do stocks and bonds, you have passive pre-built portfolios that you can just dollar cost average into without even worrying about building a portfolio. If you want to get fancier, they certainly do have those options. If we go into the general investing category, this is going to give you set portfolios based on your risk tolerance. So let's say you have very high tolerance for risk. You could go for the ultra aggressive portfolio, and it'll show us down here what your holdings are. Oddly enough, they're all Vanguard ETFs because these are the best ETFs out there. I'm not going to go through all of the holdings, but based on the expert analysis, they've constructed a portfolio that is going to give you, ultra aggressive exposure here. So high risk, high return. And then, so it looks like, look at this here. It's very heavy in equities. You got a little bit in REITs and like 1% in bonds. So you're mostly equities here. Whereas if we go ultra conservative, as I'm sure you guys can bet, you're looking at mostly bonds. But here's an example where you have some different stuff in here. You have some iShares products. That's another fund provider. For whatever reason, the people who built this portfolio must have found this fund more appealing for this. So you have the iShares Treasury Bond ETF, the iShares National Municipal Bond ETF, and then all the equities exposure is through the Vanguard ETFs. So that's another area you can get into here, is just using these pre-built portfolios based on your risk tolerance. And then another thing I love about M1 Finance is that they offer retirement accounts, again, commission-free, fee-free, with a minimum of just $500. So if you want to do like the Roth IRA or traditional IRA, you can do so through M1 Finance. And this is one of the coolest things they offer, in my opinion, is the target date retirement funds, where basically what you would do is this. Let's say I'm opening up a Roth IRA. I'm 24 years old right now, so I'm expecting to retire in 40 years, okay? So I would pick a retirement date of 2060, which is literally what you do with this drop down. And then you decide, do you want aggressive, conservative, or moderate? So let's just say I go right in the middle. Well, there you go. This is a portfolio designed for a 2060 retirement. And as I get closer to retirement, it's going to change the allocation here to become more conservative. So this is like the definition of a set it and forget it portfolio. If we scroll down here, it'll tell us more about this portfolio, why these assets were chosen. And again, it is basically all Vanguard ETFs. There's one in here from Invesco. I'm not familiar with this fund, but again, it's a very diversified exposure to different ETFs, and it's going to change as I get older. So again, you just can't get any simpler than this. Investing with a target date retirement fund that's going to reallocate as you go. You dollar cost average, you can automatically contribute money every single month. And then as you get closer to retirement, it's going to reallocate that asset blend to become more conservative. So these are the expert portfolios, guys. There's also other ones you can get into. There's hedge fund followers, income earners, other strategies. I mean, you know, if you wanted to invest in cannabis stocks or all kinds of just random stuff in here. This is a video about ETFs, so we're not going to get into these other portfolios, but I just want you to know that there's many different options available here to you relating to M1 Finance. Now, that being said, let's say, you know what, you want to build your own portfolio from scratch. Well, you can do that. You can go right here to funds and you can select the funds, like here we go, VTI, VOO, ones we've already talked about. And you can construct your own portfolio from scratch. So again, if you want to do something like I've done here, where you have, you know, a portion of your money in the Vanguard 500 ETF and you have some in individual stocks, you have the flexibility to do that. And then basically the way this would work, so if I were to put more money into this portfolio, it would invest it across my portfolio based on my target allocations here. So if I put $500 into this portfolio, it's going to put most of it in the Vanguard 500 ETF and the rest of it across these three different stocks. So you could build your own portfolio of Vanguard ETFs, only ETFs. You could also include individual stocks. You could also do an ETF portfolio and an individual stock portfolio to compare the two. Or if you just want to be as passive as possible with it, you know, take advantage of these expert pies. But there's no other brokerage out there that I've come across that offers this type of guidance and these expert portfolios commission-free, fee-free. And so that is why I'm just so comfortable with recommending them and bringing them to your attention, because they are honestly the best brokerage out there that I've found for these specific use cases. But anyways, guys, that is going to wrap up this video. That is ETFs in a nutshell. If there's anything I didn't cover and you have any questions, drop me a comment down below and I'll do my best to answer them. And like I said, if you do want to explore M1 Finance a little bit more or click around on the Vanguard website, I have links for everything down in the description below. And I certainly do appreciate your use of the affiliate link if you think you want to sign up for M1 Finance. It just helps me out a lot and helps support me and allows me to make more videos just like this one. But thanks so much for watching, guys. I hope you enjoyed it, and I will see you in the next video.